I'm sure you've heard this statement before. Be fearful when others are greedy and be greedy when others are fearful. Now, given that markets have been falling since September 26, 2024 and investors are a worried lot, this is the perfect time to be greedy, right? But that doesn't mean we should throw caution to the wind. So while it may be a good time to pick stocks for the long term, it is also important to invest only in fundamentally strong companies. And today, I will tell you a few such stocks that are also available at a discount. Hello and welcome to ET Money's YouTube channel. In this video, we will use a unique approach to shortlist fundamentally strong stocks that are also available at a discount to their historic valuations. So, if you have been looking to build a stock portfolio or add stocks to your existing portfolio, this video will be immensely helpful. But a disclaimer, the stocks we'll be talking about are not our recommendations. These stocks are the outcome of a unique approach we will be using. So I encourage you to dig deeper into these companies before investing in them. Now this video belongs to our playlist on how to pick stocks. You can check the link in the description if you want to watch more such videos. Okay, let me start by introducing you to the unique approach I just mentioned. To shortlist fundamentally strong stocks, we will use the Piotrowski F-score. We will actually be using a modified version of the Piotrowski F-score, but more on that a little later. First, let me explain what the Piotrowski F-score is. Joseph D. Piotrowski is an associate professor of accounting at Stanford University's Graduate School of Business. He introduced the F-score or the financial score in his research paper titled Value Investing: The Use of Historical Financial Statement Information to Separate Winners from Losers. The Piotrowski F-score method is a 9-point quantitative framework to pick fundamentally strong stocks. It identifies high-quality stocks are those that are profitable, have improving margins, don't employ accounting tricks, and demonstrate strengthening balance sheets. The 9 metrics of the F-score are further divided into 3 categories. First is profitability, which has 4 metrics. Second is leverage, liquidity, and source of funds. It has 3 metrics. And the third is operating efficiency with the remaining 2 metrics. Now the F-score is calculated based on these 9 metrics. Every metric that the company clears gets 1 point. So a company can have a maximum score of 9 points and a minimum of 0. A score of 8 or 9 is considered good and indicates fundamentally strong companies. Now a score of 3 to 7 indicates companies with mixed strength, with the higher the score the better. And a score of 0 to 2 indicates fundamentally weak companies. Okay. Let's now talk about how we modified Piotrowski's criteria for our purposes. To calculate the 9 metrics, Piotrowski considered the latest year numbers. In other words, the Piotrowski F-score is based on recent performance. A company that does well in the latest year will clear the criteria, and a company that doesn't do well won't. Also, while Piotrowski aimed at picking quality value stocks, no valuation metric is included among the 9 metrics. So, we decided to do 2 things. First, we considered not just the latest year, but numbers over the last 3 years. We felt that this would make the score more robust, but then we also realized that would eliminate many companies that would have otherwise cleared the original Piotrowski criteria. Now to compensate for this, we decided to shortlist companies with a combined score of 7 and above against the original criteria of 8 or 9. Second, we also checked the valuations of the company with a modified Piotrowski F-score of 7 and above so that we could acquire fundamentally strong stocks at a discount. These 2 modifications set our modified F-score apart from the F-score given by many online stock screeners. Of course, it required us to run calculations for each of the 9 metrics separately, and that too for multiple years. But this is what makes this video unique. Nowhere else would you find stocks as per more robust F-score. Next, let's take a look at the 9 modified criteria in detail across the 3 categories. As discussed earlier, Piotrowski's profitability criteria has 4 metrics. Let's first check them using the original method, and then we will see their modified versions. First is positive return on assets or ROA in the latest year. ROA or return on asset is obtained by dividing the net income by total assets. A positive ROA indicates that the company is profitable and uses its assets efficiently. Second is a positive cash flow from operations or CFO in the latest year. A positive CFO indicates that the company's core business is generating cash. Third is an improving ROA over the previous year. A higher ROA indicates improving profitability. And the fourth is the higher cash ROA than the ROA in the latest year. Piotrowski referred to this as accrual. Cash ROA is calculated by dividing the CFO by total assets. A higher cash ROA than ROA indicates quality of earnings and they are backed by cash flows. Let's now see how we modify these four metrics for our purposes. In our modified Piotrowski F-score, we looked for companies in the BSE 500 group of stocks with a positive ROA for not just one, but for the last 3 years. A positive CFO for not just one, but the last 3 years. An improving ROA as compared to not just the last year, but each of the last 3 years year on year. A higher cash ROA than ROA not just in the latest year, but in each of the last 3 years. The number of companies that clear this criteria and hence got 1 point each are on your screen. Admittedly, the metrics of improving ROAs and higher cash ROAs for the last 3 years proved to be the acid test for companies. Only 71 companies got 1 point each in the former and 124 companies got 1 point each in the latter. Let's now move to the next criteria: leverage, liquidity and the source of funds. This criteria has 3 metrics. Let's first see what they are in the original Piotrowski F-score methodology. First is the decreasing leverage or indebtedness. This is denoted by the ratio of long-term debt to total assets. The ratio of long-term debt to total assets in the current year should be less than the previous year. A reduction in leverage helps reduce financial risk, hence this metric. The second is increasing liquidity. For that, a company's current ratio should be better than in the previous year. The current ratio is calculated by dividing the current assets by the current liabilities. An improvement in the current ratio indicates a company's ability to better meet short-term obligations. And the third metric is no equity issuance. That is, the company should not have issued new shares in the previous year. Now, according to Piotrowski, financial distressed companies often resort to issuing new equity capital to raise funds as they are not able to increase sufficient funds through their operations. Let's now see how we modified these criteria. First, the leverage should be decreased not just for the current year, but for the last 3 years, year on year. Of course, if a company's debt is 0, it can't go lower. So we consider this fact in our calculations. Second, the current ratio should have improved not just in the latest year, but for each of the last 3 years, year on year. And third, the firm should not have issued equity shares not just in the last 1 year, but over the last 3 years. One important thing here. Many times companies issue shares not to raise capital, but as employee stock options or due to some corporate amalgamation or merger. New shares also come into being due to bonus issuances and stock splits. Both of these don't indicate the need for a new capital. So, we removed all such instances of equity issuances where the intention was not to raise additional capital. Let's see how many companies of the BSE 500 index cleared these 3 metrics. Here, improving liquidity proved to be the most stringent measure that only 65 companies were able to clear. All companies that cleared the 3 metrics got 1 point each and those who didn't got a 0. Let's now move to the third and the final criteria, operating efficiency. This criteria has 2 metrics. The first is a higher gross margin than the previous year. Gross margin is obtained by dividing the difference between net sales and cost of goods sold by net sales. COGS or cost of goods sold takes into account only such expense items that have a direct relevance to the production of goods or services. COGS includes raw material cost, employee expense, power cost, etc. It excludes SG&A or selling, general and administrative expenses and marketing costs, which don't have a direct relationship with the production of goods or services. This also sets gross margin apart from operating margin. Operating margin also includes indirect expenses such as SG&A expenses and marketing costs. The second criteria is improving asset turnover over the previous year. Asset turnover is calculated by dividing revenues by total assets. A higher asset turnover indicates efficient operation as the company is able to generate higher sales per rupee of assets or fewer assets are required to generate the same amount of sales. Let's see how we modify these 2 metrics to make them even more robust. First, the gross margin should be improving each year for the last 3 years year on year. Second, the asset turnover ratio should be improving for each year for the last 3 years to year on year. Now the table on your screen summarizes the outcome after applying these modified criteria on the BSE 500 stocks. Both the metrics proved to be hard nut to crack for most companies, with only 46 getting 1 point each for the former and 94 for the latter. Next, let's see how the BSE 500 companies performed in terms of the aggregate modified F score. Overall, just 17 companies managed to get a score of 7 or above. These are the fundamentally strong stocks we are looking for. A vast majority of 334 companies had a score ranging from 3 to 6. These companies have medium fundamental strength as per the modified Piotrowski criteria. Finally, 60 companies managed to get only 0 to 2 points, which indicates their poor fundamental standing. In the next section, let's take a look at the 17 companies that emerged as winners and assess their valuations. But before that, if you have found this video useful and would like to watch more such videos, do subscribe to the channel. And don't forget to press the bell icon so you never miss a video from us. These 17 winners of this research from the BSE 500 group of stocks are on your screen, along with their scores across the 9 metrics. The bigger names in the list include ABB India, Adani Power, DLF, Hindustan Aeronautics, L&T, Siemens and Tata Power. The toppers with an aggregate score of 8 are 3M India, ABB India, Container Corporation, KPIT Technologies and Siemens. The rest have a score of 7. As discussed, let's also check their valuations to select the stocks at a discount. We will use the PE to 5-year median PE metric to assess their valuations. A value of less than 1 will indicate a discount to median valuations and vice versa. Now, thanks to the market fall in the last few months, most of the 17 shortlisted stocks are available at a PE less than the median PE. That is, their PE to median PE ratio is less than 1. Only 2 stocks appear to be expensive. Hindustan Aeronautics with a PE to median PE of 1.82 and Usha Martin at 1.43. The remaining 15 stocks are at a reasonable valuations. You can consider these stocks for your portfolio after doing your own due diligence. If you need a financial data on them, you can go to the ET Money app or website and search for the company. Here you can find the company's financials, including the income statement, balance sheet, cash flow statement and financial ratios. You can also compare a specific company with its peers and find out its shareholding details, technical indicators, and history of corporate actions. Okay, let us discuss a couple of important aspects about the Piotrowski F score in the concluding section of this video. The Piotrowski F score is a sophisticated method to select high-quality stocks. Its strength lies in its rigorous 9-point framework. But like any other approach, it has its limitations as well. First is that the original Piotrowski F score considered only the recent year performance. We tried to remove this limitation by considering 3-year data. Second, many of the metrics of the F score method are not relevant for banking, finance and insurance companies. That's why we considered only non-BFSI companies in this research. So, the point is that the F score method can't be applied to BFSI stocks. Third, and the most important, Piotrowski's objective of formulating the F score methodology was to select high book to market or BM stocks. High BM companies are those whose book value exceeds their market cap. This is not a new measure, but the reverse of the classic price to book ratio. So in other words, high book to market companies are low PB stocks. PB is a more relevant metric to value asset heavy companies. This explains why many of the metrics in Piotrowski's 9-point framework revolve around assets. Now, the focus on assets makes Piotrowski's framework to be of limited use for asset-light and new age companies and for service-oriented sectors like IT. So, do keep these things in mind when you consider the stock selected as per Piotrowski's F score. And with this, we have come to the end of this video. I hope you found this video useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.